The race for dominance in the artificial intelligence AI cloud infrastructure market is heating up, and two standout players, Nebius Group and CoreWeave, are capturing the spotlight with their explosive growth. But here's the burning question. Which AI stock truly offers the better investment opportunity? Let's dive deep into the details and uncover what sets these two companies apart and why this decision might not be as straightforward as it seems. The AI cloud boom, a trillion-dollar opportunity. The surge in demand for cloud infrastructure tailored specifically for AI workloads is nothing short of phenomenal. Both Nebius and CoreWeave have ridden this wave to spectacular stock market performances, with gains exceeding 200% in 2025 alone. This growth is fueled by a massive, rapidly expanding market that could reach nearly $1.2 trillion by the end of the decade, encompassing infrastructure as a service and platform as a service sectors. Nebius Group, the Microsoft power play. Nebius has recently made headlines with a groundbreaking 5-year contract with Microsoft, valued at $17.4 billion, potentially rising to $19.4 billion if Microsoft opts for additional services. This deal is a game-changer for Nebius, a relatively small company that reported $156 million in revenue in the first half of 2025. What's truly astonishing is Nebius's revenue growth rate, a staggering 545% year-over-year increase in just 6 months. Analysts forecast that Nebius could close 2025 with revenues soaring 390% to $576 million. The Microsoft contract not only validates Nebius' technology and capacity, but also provides the financial muscle to accelerate its expansion plans. This is crucial because the AI cloud market is currently grappling with a shortage of computing capacity, leaving tech giants like Microsoft, Google, and Amazon with significant backlogs of AI workloads waiting to be processed. Nebius is aggressively scaling its data center capacity, aiming to surpass 1 gigawatt (GW) of contracted capacity by the end of 2026, up from 220 megawatts (MW) at the end of the previous quarter. The Microsoft deal is expected to further boost this expansion, as Nebius plans to reinvest contract proceeds into building new data centers to meet the surging demand. This rapid capacity growth underpins the optimistic revenue projections for 2027, with some estimates suggesting Nebius's top line could multiply more than 6.5 times within 2 years. CoreWeave, the capacity giant with a massive backlog. CoreWeave operates on a similar business model, leasing GPU-powered data centers to customers run on AI workloads. Its growth story is equally impressive, with first-half 2025 revenues climbing 275% year-over-year to $2.2 billion. CoreWeave's full-year revenue forecast of $5.25 billion indicates accelerating momentum in the latter half of the year. What sets CoreWeave apart is its sheer scale. At the end of Q2, it boasted 470 megawatts of data center capacity, with plans to nearly double that to 900 megawatts by year-end. Even more striking, CoreWeave has secured contracts for 2.2 gigawatts of data center capacity, more than double Nebius's contracted capacity. This larger footprint explains CoreWeave's higher revenue base. Additionally, CoreWeave's acquisition of Core Scientific is expected to further enhance its capacity and market reach. The company also reported a massive $30.1 billion revenue backlog at the end of Q2, an 86% increase year-over-year, driven by new contracts with AI leaders like OpenAI and existing clients. As CoreWeave brings more capacity online, it's poised to convert this backlog into substantial revenue growth. Valuation. On the other hand, Nebius's premium valuation might be justified by the potential acceleration in growth fueled by the Microsoft contract. This makes Nebius an intriguing choice for investors willing to embrace higher risk for potentially higher rewards. So, which AI stock should you choose? If you're looking for a more established player with larger capacity and a cheaper valuation, CoreWeave stands out as the safer bet. However, if you're an adventurous investor who believes in the transformative power of the Microsoft partnership and Nebius's rapid expansion, Nebius could offer outsized returns despite its current high valuation. A word of caution and opportunity. Interestingly, despite Nebius's impressive growth, it didn't make the Motley Fool Stock Advisor's list of the top 10 stocks to buy right now. This list has a track record of identifying market-beating stocks. Netflix and Nvidia were once on it, turning $1,000 investments into hundreds of thousands over time. The stock advisor's average return of 1,064% far outpaces the S&P 500's 190%. This raises a provocative question. Is Nebius's current valuation too rich, or is the market underestimating its long-term potential? And what about CoreWeave? Does its lower valuation mean it's undervalued, or is there hidden risk? What do you think? Are you leaning toward the established scale and valuation appeal of CoreWeave, or does Nebius's explosive growth and Microsoft deal make it the more compelling choice? Could Nebius justify its premium price, or is CoreWeave the smarter, more cost-effective way to play the AI cloud infrastructure boom? Share your thoughts and join the conversation below. Your perspective might just help others navigate this exciting yet complex market.